Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, April 17th. The markets continue to be shaken by trade headlines as the Fed President Jerome Powell calls for caution regarding rising inflationary pressures and the fact that they could have longer lasting effects than just temporary. On the other hand, the European Central Bank is expected to cut the interest rates by 25 basis points today. TSM just announced better than expected income, but a part of that strength is probably due to the front loading of demand before the tariffs hit, and Netflix will be reporting later today after the closing bell. So yesterday was yet another ugly day of trading, especially for the US and the technology companies there. Discouraging news started actually flowing since early hours of the European session. ASML, the Dutch ASML, actually announced a bigger than expected fall in its orders in the first quarter of this year, and the CEO of the company blamed the tariff uncertainty for the soft numbers that they announced. A few hours before that, remember, Nvidia was told to get a license to sell its H20 chips that are made for the Chinese market to China, and hence announced that this would lead to a $5.5 billion write-off in the current quarter. Then we had a very slight optimism as China said that the country could be open to negotiations with the US if Donald Trump and his administration showed respect to China. Now, some people thought that this looked like opening the door to some de-escalation of the tensions between the two giants, and while others laughed. And finally, the Fed President Jerome Powell said the last word yesterday, and it wasn't a positive word, mind you. He said that the tariffs were significantly higher than they expected. They could actually soften employment and boost inflation in the US, and that inflation could actually stick around longer than they previously thought, and that they didn't know how long the impacts of this additional inflation will flow through the economy and how they will impact the long-term inflation expectations. He added to all that they cannot achieve long-term strong growth in the US and strong employment market if they don't achieve price stability first. So in simple words, Jerome Powell said inflation is now their priority, and that the best thing to do right now is to wait before cutting the interest rate. Voila. On the economic data front, well, the US retail sales jumped last month as households in the US rushed to buy things, including cars, of course, before the tariffs hit. Then industrial production in the US slowed more than expected by analysts, and the Chinese low-price retailers, Temu and Shein, they both said that they will be raising the prices of their products as they are no longer benefiting from the so-called de minimis exemption from the US tariffs. Volkswagen, on the other hand, tried to reassure a little bit, saying that they won't be immediately raising the prices of their cars to calm down the market. But voila, if I were in America, I would actually buy a few things today rather than tomorrow, because I know that the prices will be going higher due to the tariffs, and that's a perfect inflation booster, mind you. Tariffs or not, just the expectation of tariffs is enough to boost inflation. And note that this time, rising inflation expectations in the US are not necessarily impacting the rest of the world, at least not just yet, because normally, I say previously, when the inflation expectations in the US were rising, the Fed would be expected to tighten the monetary policy in the US, and that would lead to a stronger US dollar across the board, and the strength of the US dollar would then spread inflation toward the rest of the world, which buy things in the international market in terms of US dollars. But because now the US dollar is weakening on waning US growth expectations, the rising inflationary pressures of the US are much less threatening for the rest of the world, and that's very much positive for the rest of the world. And a potential supply chain crisis across the globe would be bad and harmful for everyone, but there's always a chance actually that the rest of the world reorganizes their supply chains in order to limit the negative impact of the US trade policies on their own economy. So that, I think, is going to be the major challenge of the next 4 years, the rest of the world's capacity to learn to live without having the United States in the center of the world. Now, in the equities space, the European stock markets were actually relatively stable yesterday, and that despite a 7% plunge in ASML post-earnings. The Stoxx 600 index managed to close the session just 0.18% lower and above the 500 psychological mark, and also above the major 38.2% Fibonacci retracement on the March to April retreat. TSM, on the other hand, announced better than expected income just this morning, but a part of that strength could actually be due to the front loading of demand before the tariffs hit. So it's not outright positive, is to be taken with a pinch of salt. As such, sentiment remains fragile, meaning that any positive momentum that we might see in equities could be hard to defend. Note, however, that the European defense names lead the rebound as the geopolitical tensions with the US and the European Union and the rest of the world don't give signs of abating. As such, the euro and the European assets will likely continue to outperform their US peers and the US dollar. And today, the European Central Bank will probably announce a 25 basis point rate cut in the Eurozone to provide some more relief to the European economies in the middle of this trade and global turmoil. Then the European Central Bank President, Madame Lagarde, will probably refrain from making any commitments to future interest rate cuts, as the path of the monetary policy is highly dependent on the trade developments, obviously. It's also dependent on the fiscal responses from the underlying Eurozone countries to the actual crisis and the end result of the Eurozone economy and the price trends in the zone. The fact that the euro unexpectedly shined in the first quarter of this year, and also the significant decline that we saw in energy prices in the first 3 months of this year, are actually supportive of growth for the European economies, and there's always this chance that the European Union and the United States reach a trade deal in the coming weeks or months. So that would be the best of both worlds, mind you. The European Union would still spend big to strengthen their military and infrastructure while not taking a major hit on the trade front. As per the euro, well, the outlook for the single currency remains quite positive, both against the US dollar and against sterling, on rising reserve demand for the euro and the bets that the ample fiscal spending from the Eurozone economies would accelerate growth in all cases. Now, across the pond, well, there is little to be happy about. The markets, they were actually shattered at yesterday's trading session, as I said before. Nvidia lost almost 10% during the session, but closed the session near 7% lower. That's still a big hit. AMD, on the other hand, which is also facing the same Chinese pain than Nvidia, tanked more than 7.30%. The Magnificent 7 tanked nearly 4%, and the S&P 500 fell more than 2%. Meanwhile, the US 10-year yield fell below the 4.30% mark yesterday. That's a good sign. It at least means that some safe haven flows fed into the US 10-year papers instead of going directly into gold and the Swiss franc. But gold obviously remains bid and hit another record high this morning in Asia, while the Swiss franc remains strongly bid on the back of the safety reasons, obviously. Now, the Swiss franc's strength in this turmoil revives bets about a potential Swiss National Bank intervention into the 0.92 level against the euro. So that's the level that's being pointed out right now. Yet I think that direct currency intervention is too politically sensitive when the government, the Swiss government and US government, are in the critical negotiations period to lower the 30% tariffs on Swiss exports toward the US. So if I were the Swiss National Bank, I wouldn't want to worsen a diplomatic crisis and just cut the rates instead, but that's just me. This is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.